So in order to map out that road and the chart for today, I'd like to introduce our first speaker, Tom Joyce. We appreciate very much you coming here and highlighting. He's the managing director and of Deutsche Bank Securities. So I'm going to leave the floor to you and look forward to hearing what's in store for us. Thank you.
Thank you very much, Ulla, for having me here today. My name is Tom Joyce. I'm a capital market strategist at Deutsche Bank here in New York. I am a market specialist. I am not an economist, but I will talk a lot about the global economy. One of my goals today is to, in this brief 35 minutes, cover the global landscape and leave you with this notion that I think we all intuitively feel, that politics and policy are having an outsized impact on the global economy and on our markets. And it is getting very difficult to forecast. And what I often tell companies, I travel the world and I visit corporates, I speak at board meetings and CEO offsites and CFOs and treasurers. I speak to executives for corporations much more so than investors. I speak to companies in most of my time. And what I often tell companies, and what I'm here to tell you today, are things along the lines of whether or not you have a business in the UK, for example. The UK Brexit process matters for your business. Whether or not you have a business directly exposed to China, China matters enormously for your business. Whether you have a high exposure to the US economy in your business, the US election matters massively for your business. Let's take those one at a time. Brexit. Brexit happens, the vote in June 2016, and unbeknownst to many, while we're all focused on that existential question, what does it mean for Europe, something different happened 3 weeks later. In July of 2016, we had the largest global interest rate shock in history. European bond yields went to 500-year lows. The 10-year U.S. security, the 10-year U.S. Treasury yield went to a 225-year low of 136. By the way, the same thing happened again this summer. By September 3rd, the U.S. Treasury had collapsed down to 141, and we had 17 trillion of negative yielding securities across Europe and across Japan. The global economy and the U.S. economy, our markets were telling us that we were at risk of going into recession on the back of the trade war. So all of these things impact us in ways that you may not necessarily immediately think. Secondly, these things have become very difficult to forecast. This time last year, last January, the conventional view on Wall Street by research analysts, including at the IMF and the World Bank and elsewhere, was that the Federal Reserve, that growth was going to be so good that the Federal Reserve would raise rates 3 times. Well, the Fed cut rates 3 times. The conventional view on the street was that the 10-year U.S. Treasury would go to 3.5% by mid-year. It went to 1.4. They only missed it by 200 basis points. We had 23 economies in the world last summer. 6 months ago, we had 23 economies in the world in a manufacturing recession, including the 5 largest, the United States, China, Japan, Germany, and the UK. India has since surpassed the UK as the world's 5th largest economy. But the 5 largest economies in the world, in 23 total, were in a manufacturing recession, due largely to policy decisions and politics. And so we begin this year, and already the consensus view on the global economy, the consensus view on global markets is incorrect. We've had the 10-year U.S. Treasury on the back of the coronavirus, a widely unexpected development for understandable reasons, go down 40 basis points. Rates markets today are telling you that there is a growth scare in the global economy, and it is sizable. And we've now had, as of yesterday, the 3rd 20% correction in global oil prices in just 18 months. The first 2 were caused by the trade war, the 3rd one by the coronavirus. So let's get into it. It's not Armageddon. I'm sorry to start on a daunting note. Not nice to start the morning off with a virus, but it's front and center in our markets. There's a tendency to look at this problem this concern, this huge humanitarian development, and focus on SARS in 2003, and it's understandable, a virus that had originated in China. We can easily overdo the analogy. The SARS mortality rate was higher, 8%. This one's about 2%. But the infection rate here, the transmission rate, is much stronger with this disease. 17,000 people infected today. I can't keep the slide updated quickly enough. We're north of 20,000 in the lower right with the coronavirus. That's already double SARS. Now, the market is doing well for two reasons. The market is absorbing this for two reasons, and we do take comfort from these two reasons. Number one, the transmission rate appears to be slowing down, certainly outside of China slowing down. But there's a lot of risk to that view, and actually the jump in the numbers overnight and some of the faultiness in the reporting, and not discrediting China. It's just not easy to, on a daily basis, accurately aggregate all of this data. But it appears that the rate of transmission is declining outside of China. Our own view at Deutsche Bank, our China economist, believes that we will peak within China, within Hubei province, sometime in mid-February. There's a lot of risk to that view. But that's the view today. The market is responding well, and the market's a proxy for what it thinks the economy is going to do globally. The market is responding well because the transmission rate appears to be slowing down. We hope that's true. And then secondly, China is responding very swiftly with liquidity and support to the economy. Just over the weekend, they exceeded expectations. They reduced their monetary rate by 10 basis points. They introduced tremendous liquidity, the largest liquidity in a decade, into their banking system. And they have indicated that they will do quite a bit of fiscal stimulus. The other reason the SARS analogy is fairly limited is China in 2003 was a shade of what it is today. China in 2003 was 4% of global growth, as you can see in the upper left. China today is 17% of global growth. I'm sorry, let me restate that. China is 17% of the global economy. It is 30% of global growth. And it is 34% of oil demand growth globally for the last 20 years. So if China slows down just a little bit, it hits oil prices immediately. When China slows down, it ripples through the U.S. Treasury market, the U.S. equity market, the Pan-Asian region economically. It impacts almost every economy and market globally. China today is a very different country than it was just 15 years ago. We are a little concerned, though this is very low on the list of priorities. The concern, of course, is with China's economy weakened considerably, and I think it has been and will be weakened considerably by this virus development. The sheer scale of the shutdown underway across China, the supply chain disruption, the pullback in consumer behavior. The concern is, of course, and this is very low on the list, but it's relevant to policy risk, is that China will have difficulty meeting its purchase obligations on the U.S.-China trade deal. I'll return to that trade deal later in the discussion. But what you see here, I know many of you may not be focused on global interest rates on a daily basis, but what you see here is that the market is telling you we have a major growth shock underway in the economy. That 3-month 10-year Treasury curve in the lower left, not that you're focused on the 3-month 10-year U.S. Treasury curve, but if you look at the 10-year, if you look at that curve and you look at the last 10 U.S. recessions going back to 1950, and the United States is almost 25% of the global economy. If the U.S. economy goes into recession, it will ripple through every single economy globally. And if you look at that lower left chart, that chart has been, since 1950, the single most accurate predictor of every U.S. recession, all 10 of them going back to 1950. And when that curve inverts, recession typically follows it a year later. That curve inverted this summer with the trade war. It then recovered since September. It is now inverting again. It doesn't mean that this time the U.S. economy will go into recession. What I'm trying to tell you is the trillions of dollars, trillions, in global fixed income markets are telling you that there is a legitimate growth shock underway in our markets. Now, the good news here is that there is a very swift and aggressive policy response led by China. The first thing is when rates go so much lower, point number one, the bond market is doing the work for the central banks. The bond markets are easing policy by getting ahead of the central banks and lowering rates, and that is good for growth. OPEC is talking about a production cut. If this does get worse than expected, we would expect a G20 policy response. The SARS precedent does suggest this will be temporary. When SARS happened in 2003, the impact at its worst was about a 1% hit to the Chinese economy for 1 quarter, but then they made it all back almost in the second quarter. We think this time the bounce back will take longer, maybe a couple of quarters, because China is a more services-oriented economy today. Services are 53% of GDP. So the bounce back may take a little longer, and the hit will probably be a little deeper. Deutsche Bank is currently forecasting a 1 to 1.75% hit to the Chinese economy for 1 quarter as a result of this. I suspect, and I'm not an economist, so don't listen to me, I'd listen to the PhD folks. I'm here to tell you I think it'll be a little more. And I've already mentioned point number 5. The China policy response has been enormous on several fronts, both in terms of containing the virus and in terms of the support for the economy. So most of this bodes well with something that we still are trying to understand in terms of its power. The hope is that this is a temporary shock, but the timing is not ideal. It's coming off a year where the global economy had already been hit quite hard by the trade war. We hit bottom in August, and the global manufacturing numbers, the global economic numbers across China, across Europe, across many economies had been improving since August. That was the good news. The bad news, or the concern, I should say, is that that improvement was reasonably modest and therefore, by definition, vulnerable. Let's move on to another pleasant topic, the U.S. election. I like to joke, we don't even have results out of Iowa last night. As a result of a technology failure, we're going to have to pull Iowa into the tech age. The U.S. election. Let me spend 10 minutes on it and take you through some of the nuances of the U.S. election. We call it the road to 270. For many of you who are not from the United States, I suspect you know more about U.S. electoral politics than Americans. But I will tell you that we have this system in the United States. We do not have direct popular vote, as you know. We have this electoral college system that was a compromise by the Founding Fathers in 1787 between those who wanted the president directly elected and those who wanted the Congress to elect. It is a largely direct system, but it is designed in such a way to not have the large states like California, Texas, and New York completely dominate electoral politics. It's designed to give some power to the Rhode Islands and the South Dakotas and so forth. The reason I go into that detail, as you know, is that we have only had 4 occasions in U.S. history, and 2 of them have happened in the last 20 years, and I think it might happen again. We have only had 4 occasions in 230 years where the popular vote didn't result in the same result as the Electoral College. 1876, 1888, then it happened again in 2000. We took a 125-year break from that mayhem. And it happened again in 2016. And I think there's a really good chance that President Trump could lose the popular vote by 6 to 7 million votes and still become president of the United States. Let me go into some more detail. And this is relevant to the global economy. It's relevant to the U.S. economy. We have never had such progressive candidates as front runners. I am not applying a value judgment to Bernie Sanders, but he has $30 trillion of tax and spending proposals. And the market thus far, for 4 or 5 months now, has been assuming a 90% probability that the winner is either Trump or a moderate, i.e. Joe Biden. And now we have Bernie Sanders as a front runner. The market will begin to reprice, should he continue his strong run through this primary process, which began yesterday. The market will begin to price. History shows you that business CapEx will pull back as it thinks this election is close. The significance of this election let's just put aside the long-term policy implications if Trump is in office or not. Our markets trade differently in years in which it is believed to be a close election. And our markets trade differently when uncertainty is high. And our markets will trade differently if a candidate with $30 trillion of tax and spend appears to be the winner of the Democratic nomination, even though it'll be difficult to get a lot of those policies through. And business CapEx, which is so important to the economy, pulls back in years in which you have a close election. Bernie Sanders has risen to the top in the first two stops, Iowa and New Hampshire, but he's also ahead in California, which comes up on March 3rd. If you look at the process, what I will say is February and April is the critical time for global markets on this topic, not November. November is important, but the process will play out on the Democratic side between February and April, and the market will form its opinion then. And the way this Democratic primary process works, by the end of February, we'll be 4% of the way through. On Super Tuesday, March 3rd, you have 20 states go on the same day, something like that, and we'll be 38% of the way through. End of March, 65%, end of April, 87%. This all occurring at a time when policy risk globally is pretty high. Mike Bloomberg, I'll make a comment on him as a candidate. He's not doing well on the trail, so to speak. He's not necessarily viewed as a strong campaigner. He's viewed as an effective politician, but not a strong campaigner. But we have no precedent for somebody spending $1 to $2 billion of their own money to impact an election. The question we should be asking ourselves about Mike Bloomberg and his impact on this election and his impact on the possibility of President Trump being reelected is not, will Mike Bloomberg become the nominee on the Democratic side? He may or may not. I would say unlikely, but you never know. The question we should ask ourselves is, what is the impact of somebody spending $1 billion to $2 billion of their own money in a small handful of states, Michigan, Wisconsin, Pennsylvania, Ohio, Florida, North Carolina, states that matter, to try to ensure that President Trump does not become president? Even if he drops out of the race because he's not gaining traction by March, April, he will continue to spend that money against the president all the way up to November 2nd. What is the impact, not nationally, but on the marginal independent voter, on the states that matter? History is on the president's side. He is absolutely favored to win this election. He's an incumbent with a strong economy, and we do have a strong U.S. economy. Not as strong as he says it is, but it is strong. But part of the reason that it is difficult to forecast his success is that his ratings are quite low. They are low by historic standards. But here's the other side of that same coin. They are remarkably stable. We have never had a president whose ratings trade in such a narrow range. That range happens to be low. It is just above the average rate of those who have lost re-election, and it is below those who have won re-election, and makes it a little tricky to forecast. And I will say to you that the reason we think this election is going to be close, and this has an impact on how the economy performs this year, and this has an impact on the way our markets perform. The reason we think this election is close is because there is a structural dynamic in the United States whereby we have this red-blue divide, and versions of this going on in many countries globally. And with the Electoral College system, what happens is effectively 43 states, you know where they're going to vote in advance, so the election comes down to really 7 states. By definition, it keeps it close. Here's the statistic I will leave you with, and then we'll move away from the U.S. election, to show you how close this could be, and why I think President Trump could lose the popular vote and still win the Electoral College. In 2016, here's the stat, 137 million Americans voted. 137 million Americans voted, and I would tell you that President Trump won that election by 77,000 votes, 0.05%. He did something that no Republican had done since the 1980s, and this was his great electoral achievement. He took the 3 Rust Belt states of Pennsylvania, Michigan, Wisconsin. He took Pennsylvania, where 6 million people voted, by 44,000 votes. He took Wisconsin by 22,000 votes. He took Michigan by 11,000 votes. If those 77,000 people had voted for Hillary Clinton, she would be president of the United States today. That's how close it was. And I believe that these will be the three most important states. Certainly Michigan and Pennsylvania will in 2016. Trump in 2020. Trump is polling behind in many of these states. That can change. Many of us will say the polls were wrong in 2020. No, the polls are always wrong. They are always wrong, but they're not as wrong as you think. In 2016, the polls said that Hillary Clinton was 2 points ahead nationally. Well, she won the national vote by 3 million. The polls in 2016 said that the three huge states of Florida, North Carolina, and Ohio that mattered so much, that Trump was ahead. Well, he took those 3 states. The polls were wrong in Pennsylvania, which ended up being the most important state. Those polls said that Hillary was up 2 points. Well, the margin of error on those polls was 3 to 5 points, well inside the margin of error. And so all you need in a scenario like that is for Hillary's turnout to be a point lower than expected, Trump's to be a point higher than expected, and you have a dead-even race in the state of Pennsylvania, which is exactly what happened. I'm not saying that the polls are not sometimes wrong. I'm saying that they're not as wrong as you think, and that they are always a little bit wrong. The relevance of all of this is when we have a close election, people pull back on uncertainty. Left side of the page, business spending pulls back in the months before an election. I think it'll happen even earlier this year because global policy risk is elevated. The U.S. consumer, the good news, 70% of GDP in the world's largest economy, their behavior does not change in an election year. The equity market starts to trade sideways around July. I think it happens earlier this year because stocks are elevated in valuation and we have a lot of policy risk globally. There's a narrative out there that Fed and central banks will not act in an election year. That is not true. The Fed cuts and raises rates just as much in an election year as it does in any other year. They would, of course, rather not be in the market in September, October, but they will if they have to. And the 10-year U.S. Treasury tends to decline starting around 6 months ahead of an election. Now, this has already happened because of the coronavirus, but normally starting about 6 months ahead of election on policy uncertainty, money globally, not just U.S. money, global money, tens of trillions of global money moves in the direction of safe haven assets, including U.S. Treasuries and Swiss franc and Japanese yen and gold, to ride out the uncertainty, and you tend to get improvement on the other end. Let's leave the United States and go global a little bit from a policy perspective. I've already said it, we all know it, I'll say it again. The world has gotten very complicated and it's gotten very difficult to forecast. The ascendancy, the triumphalism of capitalism as we know it is under question. We have clashes not only between civilizations, Islam in the West, China in the West, we have clashes within civilizations. Shia, Sunni, UK, Europe, Republicans, Democrats, people in Hong Kong and China. We have clashes within civilizations. And these clashes have gotten very difficult to forecast, and they are impacting the economy, and they are impacting markets. And part of the reason we can absorb it so well, part of the reason you can have US and Iran going to the edge of the cliff a month ago, and oil goes to only $70 a barrel and not 100, yes, part of that is because we have a massive oversupply of oil globally, close to 1 million barrels per day of surplus, but it's also because our central banks since the crisis have been pumping liquidity into the system at an historic rate. On this map here, the green countries, all countries and regions in green cut interest rates last year. As a matter of fact, if you look at this line chart on the right, we had more interest rate cuts in 2019 than any year since the crisis. The ECB restarted QE, the Fed is now growing its balance sheet. There is an enormous amount of liquidity being pumped into the system. And let's just hit on some of the big policy risks that we're focused on. I don't really focus per se on geopolitical risk. I happen to personally find it interesting and I follow it. But from a markets perspective, I'm going to focus on the policy issues that drive our markets. And US-China rivalry is at the top of the list. It is a mistake to think that the Phase 1 trade deal on Jan 15 was a significant step forward. It is a standstill agreement. I call it a giant agriculture purchase agreement, and it is not even that big. It is an agreement to stand still. The U.S.-China rivalry has only just begun. As one commentator I heard say, and I fully subscribe to the view, January 15, 2020, a few weeks ago, is probably the best day in U.S.-China relations for the next decade. This is economic rivalry. This is ideological rivalry. This will continue in the non-tariff arena. This is the battle for the bifurcation of global tech. This will involve Huawei. We now have 35 bills in the U.S. Congress, 35 separate pieces of legislation with bipartisan support. It might be the only thing that Democrats and Republicans agree on, which is China. 35 bills in the U.S. Congress that have a tough China agenda, whether it be on Hong Kong, Taiwan, tech transfer, IP protection, currency manipulation, cyber theft, you name the topic. These human rights in the Xinjiang province in the West, these 35 bills are indicative of the tone in Washington. Most of them will never make it out of committee, and most of them will never become law. But it is indicative of the stance. And when I go visit corporate executives in Europe, while they are generally, if I could over-stereotype the response, while they are generally not pro-Trump, they are generally applauding the tough stance on China. I am not saying I agree with it or disagree with it. I'm just telling you where I think the sentiment is in the corporate C-suite. And we shouldn't assume that this escalation is behind us. It has only begun. It is a mistake to think that the tariffs are not coming to Europe this year, and this is a concern for global growth. I think there's a narrative out there that in an election year, the election will act as a guardrail that will preclude the president from using tariffs. I do not agree with that narrative. I do think it will preclude him from acting as aggressively as he did with China last year. But the use of tariffs will continue. Many people don't even realize, because it wasn't widely reported, that just last week the president raised tariffs on steel and aluminum across a whole host of second and third derivative products. Here's how I think about it. Starting about 2 years ago, and we've seen global growth take the shock through this policy pivot, the president started largely with South Korea and Japan on steel tariffs. He moved on to Canada and Mexico. He then shifted to China. By June, he was back to Mexico. By August, he shifted back to China and Turkey. It is illogical to think this is not coming to Europe. What was the centerpiece of the U.S.-Japan trade deal? What was the centerpiece of the U.S.-China trade deal? It was agriculture purchases, which, of course, feed into the president's re-election campaign. But there's also, no question, major inequities in the global trading system, and the WTO has shown itself to not be capable of resolving the complexity of global trade and trade imbalances with China and other countries in a timely manner. I'm not defending the president's unilateral pivot. I'm actually quite critical of it. But what I'm saying is he will pivot to agriculture in Europe this year, and Europe will be reticent to capitulate on agriculture. And as a result of that, I think the tariffs are likely. Coming out of Davos with climate change, you also see Europe moving more aggressively toward carbon taxes. Wilbur Ross, the Commerce Secretary, just said last week, if Europe moves to carbon taxes, we will respond with tariffs. And of course, we've got almost 25 countries in the world implementing or considering digital taxes. Now, France in the upper left, Macron and Trump agreed to delay a year, but there are 25 countries in the world moving toward digital taxes, which disproportionately impact large U.S. tech. They may be a very legitimate approach to taxation. It may ultimately be where we are going. The significance of this, though, for the global economy in 2020 is the president has been very clear, if Europe moves towards digital taxes, he will respond with tariffs. Very complicated topic, and this is well underway. And what I often tell our corporate clients in the United States when I'm visiting Apple and Amazon and Coca-Cola and Target and Home Depot and Ford and GM, all these large American corporates, and I also tell European corporates the same thing, while we are preoccupied with Brexit, while we are preoccupied with other developments such as that in the West, while we are preoccupied with U.S. trade policy pivots, the global economy is shifting east. This, to me, is the most powerful story over the next decade, the one that we are not watching closely enough. These are the 30 largest economies in the world. These are not small economies. And of the 30 largest economies in the world, 8 of the 10 fastest growing in 2020 are forecast to be in Asia. 3 of the 5 largest economies in the world, upper left, are now in Asia. India passed the UK last year. 5 of the 10 largest companies in the world are in China. 7 of the largest 10 FX reserve balances are in Asia. 5 of the 10 largest stock markets in the world are in Asia. I know these are anecdotal numbers, but they are indicative of a trend. And while the West is pulling back and pursuing unilateralism, this sounds like a value judgment. I'm not critiquing it. I'm just saying, as we challenge the post-World War II architecture, the UK pulls out of Europe, the United States pulls out of the TPP, the transatlantic alliance is being weakened. As the West retreats toward a different construct, I would argue that the East is integrating at a faster pace than it ever has. We now have, this year, the signing of the Regional Comprehensive Economic Partnership, will become one of the largest trading blocs in the world. This negotiation began in 2012. It accelerated in 2017 when the United States pulled out of the TPP. And as you can see here, this trade agreement, which will be signed this year, involves 15 countries, over 3 billion people, 45% of the world's population, 40% of global trade, 21 trillion of GDP. And as China pulls back from the West, reduces its reliance on U.S. tech, on U.S. agriculture, that will take 5 to 10 years, but it is absolutely happening. China is simultaneously investing in trillions of dollars of projects across the world through the Signature Belt and Road Initiative. Many of these projects are quite bad, and many of them are quite good. What we're trying to say is there is no shortage of controversy and resentment across many countries with many of these investments, but China is still nonetheless positioning itself to be the global hegemonic power across the largest economy in the world, which is the Pan-Eurasian region. It sounds a little cutesy to say, but this is literally the recreation of the Marco Polo days, where the largest economy in the world extended from Western Europe to Beijing, and China dominated the terms of trade through that largest economy in the world. That is exactly what is underway today, with trillions of investment in railroads and oil pipelines and gas pipelines and ports and digital highways. And the U.S. national security complex is responding to numerous dimensions of this China global strategic push. I will stop there before I get over my skis on U.S. geopolitical developments. Let me mention one last thing, global M&A, which impacts many companies in the room. I operate at a macro level, not at the micro shipping industry level. I've got 2 minutes left. I'm going to focus on one slide only. And that is, global M&A is exploding. Last year was the 4th largest M&A year in history. It was the 2nd largest M&A year in the United States. And it wasn't just the 2nd largest M&A year in the United States. We had 18 deals globally last year, over $25 billion in size, companies merging together. Over $25 billion. Back in 2014, you would say that a mega deal in global M&A was $5 billion. Then by 17, 18, you'd say a mega deal was $10 billion. Now a mega deal is $25 billion. And there are structural reasons that is happening that will impact all industries directly or indirectly globally. Number one, organic growth globally is low. Organic growth is low. It's half of what it was a decade ago. Number two, we have trillions of dollars of low-cost capital globally. U.S. corporations alone have $2 trillion on their balance sheets. There are $8 trillion of sovereign wealth fund money, $34 trillion of pension fund money, $2.5 trillion of private equity dry powder. The world with an emerging middle class and 7.5 billion people, has trillions of dollars to put to work in a negative yielding, low return world. We have low organic growth. We have low cost capital. We have the rise of activism. Activism is no longer, shareholder activism is no longer a US concept. It is now a global concept. It is on the rise, and it is increasingly focused on M&A. And lastly, the lower left, technology. Technology is both an opportunity, i.e. I buy an asset because I need that tech capability, or I buy an asset or a company because I have a fear of tech disintermediating my business. My business strategy, my industry is under threat from technology, and so I move to M&A to respond to that. I will pause there. We covered a lot of content. I'm out of time. I probably am not able to take questions, but I will ask somebody in charge if you need to get on with the agenda. I used every second. I apologize.
Any questions? They're all stumped.
Hi, thank you. This was really interesting. Congratulations on being able to fit the world into 20 minutes or so. My question to you is whether you have made any calculations of the cost of the bipolarization we're seeing in politics and economy now, with what we could, if you were kind of extrapolating from now until some 20 years, where we see that we have more and more of trade restrictions between East and West, and also not least technology developments being polarized as well, where we might be shipping less and having less commerce in technology between the different parts of the world. China being a leader in AI, and the US being a leader in AI, and the Euro caught somewhere in the middle, and these kind of becoming their own ecosystems of technology developments with less competition on a global basis. Have you looked at what that could actually mean for the world economy?
Yeah, that's a complicated question because there's so many variables in one. I cannot calculate that for you. I wish I could. I'm not an economist, but I think even an economist would struggle to put all of those things together. What we do know is that the global economy is slowing down. And there's a whole host of reasons for that. We have rising debt globally. When you have rising debt, your best case scenario is slower growth. Your worst case scenario is that you have a financing crisis. We've got aging demographics. See, so there's a lot of other forces that are interplaying with some of the questions you raised. So you have the positive, perhaps, of technology, productivity, and yet productivity globally is low. You've got aging demographics. Last year is the first year in human history, in the history of mankind, where we had more people in the world over age 65 than under age 5. And when aging populations, when you have aging populations, your liabilities are rising, and the engine of growth, age 18 to 65, what drives the economy, is shrinking. So you have a shrinking engine supporting a larger liability. That partly explains why global growth has been on the decline. I think we also underestimate the impact of the financial crisis. There's a complex cocktail of things that are coming together. I wouldn't be able to isolate for you the economic cost of each. There's no question that trade wars are not pro-growth. There's no question that global aging populations across China, Japan, United States, Europe, there's no question that they are not pro-growth. But there are other things. There's no question that populism, which may have valid roots in terms of what is driving populism, there's no question that it is not pro-growth. There's no question that rising inequality over time is not pro-growth. But I've only focused on the negatives there. I think economists still struggle to understand and calculate the benefits of technology to growth and the benefits of globalization to growth. What we do know is that global trading volumes are down significantly, and that predated the trade war. So I wish I could give you a more precise answer. I'm going to leave it to those in charge to tell me when I should step down. Yes, sir.
Hi, Jason Tama, Coast Guard Captain Port here in New York. Great presentation. You touched on climate change and sort of its relationship to potential tariff response with this administration, et cetera. What would you say about markets pricing the risk of climate change? Is it too long-term of an issue for markets to deal with? Or what are your thoughts on that? You did cover the world in 20 minutes. But maybe that's like an additional factor out there.
Yeah, I think it's a great question, and I don't say that gratuitously. The number one issue, I've already done 30 events this year, dinners in Minneapolis and Philadelphia and Atlanta and all sorts of places. The number one issue in every single meeting I have done is ESG, environmental, social governance. It began more powerfully in Europe. In the United States, it's in the first to second inning. It is going 1,000 miles an hour, and it is here to stay. We will see, and it's already underway, the transformation of global finance as a result of environmental pressure. It is underway. The Larry Fink letter in December at BlackRock, if you have not read it, please read the Larry Fink BlackRock letter in December. It has fundamentally changed the pace, impacted the pace of change in the United States on this topic. The biggest bond funds in the world, the biggest provider of capital in the world, many of those funds, BlackRock and PIMCO and Western Asset Management, WAMCO. I have done calls with many of them. We are doing more calls each day. We are putting out a massive ESG piece in about a month. And the reason we are doing that is because investors are developing their own proprietary models. And they are scoring companies on their ESG footprint, i.e. 1 through 5. And we will only invest in companies that get a 3 through 5 score. That's the sort of thing that's going on. So investors are factoring in E, the S, and the G into investment decisions. Because the providers of capital, whether it be pension funds or sovereign wealth funds or so forth, are demanding transparency around those processes, and they see it coming. And they are moving 1,000 miles an hour. I have never in my career seen a shift on something move so quickly. And I've been in this business for 25 or so years. So I do think that in terms of investment, private equity, mergers and acquisitions, doing analysis around the exposure of assets to climate risk is something that's happening. It's already been going on for several years now. The bigger story, I think, is the broader impact that ESG is having on global finance. It is absolutely going to transform the global finance. We are not going to have industries and companies completely shut out from access to capital or punitive charges for capital. That is not the goal. The goal that investors tell me, including across Europe, is to reward companies and industries that are best in class. So even a chemical company, which by definition is not the most E-friendly institution on the planet, if you are a best-in-class operator, we are moving toward a world where the market will reward you a lower cost of capital and a larger allocation of capital for being a better performer in that industry. Okay. I'm getting the gong here. I don't know if those of you know the Gong Show, but it's time for me to get off. Thank you so much for having me.